Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what people are sharing, and I'll share my opinion as we go. If you want to follow me, it is at finding_finance. And if you want to join our community, it's finding-value.com. That's where I dive deeper into these topics, into individual companies, the technicals, trainings. I answer your guys' questions on the weekends, on either Saturday or Sunday, and I give midweek updates on Wednesdays of what I'm doing, what I think looks good in the market. And if you need help with anything with this commodity bull market, it is a great resource for anyone who wants to join our community. We also have a Discord channel where we share ideas. And we have a discount coupon code that is active right now, Mayday, MAYDAY, if you're interested. So coming on down, we got Uselink. URNM versus SILJ. This will decide whether uranium or silver miners will be the better play here for some time. Individually, both should do fine in a world where the gold to silver rather is tanking. So URNM versus SILJ. We're right at a decision point. We are at a horizontal support for URNM, and we have a trend line that's been coming on up that we could meet here very soon, where we could determine what's going to outperform what. The market conditions are what determines what's going to outperform. Silver, with its big breakout, the physical metal itself, has me. It's tough for me to believe that SILJ doesn't have a chance of breaking down. URNM, it looks okay. It's sitting on top of a lot of support in terms of dollars. So URNM priced in dollars. So this could go either way, guys. It could go either way, and I really don't know what's going to outperform here in the short term. So this will be an interesting one to see what actually outperforms. I am actually positioned in both. I'm in URNJ and SILJ are the two that I am positioned in, and I've got other positions as well to kind of diversify the portfolio versus whatever market condition comes in the short term here. And SILJ is going to outperform in a market slowdown and a uninversion of the yield curve. Uranium, I think, will do well if we're earlier in the bull market and we're not rolling over necessarily. And either one could do well here. There is no clear direction on the yield curve uninverting yet. It's still highly inverted, so it's a tough call. Flip a coin. Rock bottom entry says silver, and this is what I mean by silver breaking out here. It says there is now zero doubt. We've begun the next leg on our parabolic journey of silver. We've got a lot of resistance through here around the $30-ish level. So if we zoom in on the right-hand side here, you can see that we've come up around 32, pulled back to that 50-day EMA bounce, and we've rocketed higher back through that resistance line. I would suspect that this could be another leg higher in silver here. Again, I don't know for sure. I'm positioned for that leg higher already. We've got momentum, RSI, relative strength moving on up, and we'll see if we get that leg higher here in silver. And I know a lot of people are trying to play the short term. I don't really play the short term here. I've positioned, I think the charts look absolutely fantastic in a bunch of different equities for they have already bottomed and they're starting to work their way on up. So I am viewing that silver is going to continue higher. That would be my viewpoint when looking at the equities and the junior equity market. They look pretty good. Logan says this is the most unique housing cycle in recent history. So I understand why many of you ask how residential workers are not fired yet. The backlog of homes, the single family operators have already downsized their workforce. Apartment and remodeling labor is still rising, in his opinion. So housing starts are back down to where they were just before the pandemic via at Logan, and that's back down here. And we are kind of rolling over. We've been coming lower in those housing starts. Now, if the housing starts dip, that is generally a bad sign. that could be the beginning of a slowdown, or that we are already in the beginning of a slowdown, and that's kind of going to solidify that the slowdown occurs. What you want to look at next is, are rates going to come back down? And if rates come back down, how will that impact the housing market? How will that impact the housing starts? Are construction jobs being lost? Is residential spending down? Those are some of the things that you want to look at. They're holding together strong at the moment. So I don't think that a recession or slowdown is 100% in the bag, but as things do continue to deteriorate, if they continue to deteriorate, that can impact those other metrics, and that could lead to a slowdown in the market. It is still possible. If we get that slowdown, the way that I translate that into um, ways to play it, it would be gold and silver would start to work its way on up, because that generally goes up with unemployment. So that's kind of how I'm positioned for it. You could also see a crash at some point out in the future. That could be a ways off, though, guys. It's not immediate. Don't get too worried. It could be a ways off, a year, year and a half, or two, something like that. And we could see bonds go up as well, potentially. But right now, they're consolidating, and we don't have that breakdown yet in the 2-year yield or anything like that. So it's premature to jump on that recession bandwagon and to run for the hills. That's all too premature. That could be months or years away still. HFI Research says, I do not see any weakness in the implied U.S. oil demand. So oil demand continuing to work its way on up. There it is, working its way on up pretty strong at the moment for gasoline, distillate, jet fuel. Also looking pretty good on all the metrics here. Kerosene, supply products, distillate fuel oil. Some are down here for propane and propylene and stuff like that. But most everything looks pretty strong. Giovanni says U.S. implied oil demand, products supplied in million barrels per day, and that is a new all-time high here versus going all the way back 19, 20, 21, 22, 23, 24. It's the highest it is. So demand's pretty strong compared to other years before this. Housing starts now at the lowest level since the pandemic. U.S. housing starts and permits. So this is both permits and starts, and they are down a little bit here for the most recent data. We never went into some large home buying spree, really. I think interest rates really thwarted that move, and it slowed everything down. So this is one to monitor. We want to see if permits and starts, if they continue to go lower, maybe it's similar to a 2000, 2001 pullback where this is the mid-cycle wobble. 2020 could have been like a forced wobble, perhaps, or maybe we get a wobble here. Difficult to say. We're not in an overbuilt state. We don't have a ton of inventory. So I don't think we're at risk of a crash, but we could get a slowdown if we see housing starts continue to go lower, because that does impact the economy quite big. Wasn't coal declared dead? Well, in the real world, global coal consumption reached another all-time high in 2023. It's far from dead and won't be for many years to come. Global coal consumption continuing to work its way on up, and you can see the vast majority of the new growth is coming from Asia Pacific. So that's what it looks like, and it's coming from Asia Pacific. So I'm playing this with companies that provide coal to Asia Pacific. Apollo, a default cycle has started. Default cycle, what's going on with that? So here's one thing that I kind of wanted to point out. The default cycle, it came on up and it kind of rolled over 2001, 2002. You know what other cycle is going on right now? That's the same same area as this area over here in 2002. Remember what happened from 2002 onward? Commodities went ballistic. We had a weakening dollar, they lowered interest rates, and then we had a big move in commodities. Is it a similar setup that what we have today? It could be. It could be. We had that come all the way back down to about 2008. After 2008, we had another cycle, upcycle. 2016 had an upcycle and then it turned. Another upcycle in 2020, and then we've got this upcycle that's coming, and maybe we turn lower, where a default cycle has started, and that's trailing 12 months. So U.S. speculative grade default rates is what we're at. So hopefully we're close to like 2020, 2002, I mean, because that was when the big commodity bull market started. Social Security projected to run out of money to pay full benefits in 2033 and Medicare in 2036. That's pretty crazy to run out of money by 2033. Don't worry about looking good. Worry instead about achieving your goals. Ray Dalio. We've got warning. Reverse repo has been falling off of a cliff, going from 2,300 billion to under 400 billion in just 1.5 years. So that's the reverse repo. This is money coming back into the system. Think of that as M2 money supply coming. It's not really M2. It's already been created money supply that isn't in the money supply that is being reintroduced back into the money supply. So it is extra money that is floating around the system as this gets reintroduced back into the system. So it's extra money. Energy research says crude oil, including SPR, gasoline, and distillates, says you are here at very low level versus the 5 years before this. We've got housing here. It says single-family housing starts fall to the lowest level since last September, despite the fact that residential construction payrolls remain at cycle highs. Our models show early signs of loosening in the construction labor market. And this is not necessarily a good thing. This is where the beginning of the weakness could be coming, and that's something that we're going to watch. But this occurred, think of this as like occurring in 2005. It occurred in 2000, 2001 as well. So we could be in one of those areas, depending on what you're looking at. I don't think it's 05. I think we're probably in like 2000, 2001. We had a slowdown in that time frame. We had low inventory, and we had very high tech stocks going to the moon. This to me looks like, smells like 2000, 2001. That's what it seems like to me. And we could get a slowdown. We go through it. They lower interest rates. We get a weaker dollar, weaker yields. The housing market rips it again to the upside. And then we get a big commodity boom from similar to 2002 to 2008. And that would be your third and fifth legs of the bull market in commodities. And that's how I would expect it to play out. Margin debt expansion equals bullish momentum signal. So this is margin call. So margin debt expansion versus contraction, we are expanding. We are in the positive plus 20% here for margin debt expansion, which is generally good for the stock market and going higher, not lower. So when you see these things go from a low point to a high point, you can see the stock market goes up during those periods. And when you go from a high point to a low point, the stock market generally goes down. Apollo, the current AI bubble is bigger than the 1990s tech bubble. So they're calling it an AI bubble going on here. This is the 12-month forward PE ratio, and it is vastly bigger than the 2000 bubble that we have back there. So bubble, bubble, bubble. Attention, bank credit is now expanding after contracting only for the second time in 50 years. Recession canceled. We don't think so, according to him. But bank credit and all commercial banks heading on higher. That is a function of more money coming into the system for bank credit. We've got the gold-silver ratio, an indication of the next leg down in this ratio. Silver's about to leave $30 and look for $40 and $50 an ounce, in his opinion. We've broken from this rising wedge to the downside, which is exactly what we would expect, where silver could outperform gold in the next leg higher. And it looks pretty good for that to occur. And I would say that looks pretty good on the silver chart priced in dollars for a huge move in silver. Don't pass up something that's attractive today because you think you will find something better tomorrow. says Warren Buffett. So if you've got the deal today, go ahead and grab it and take it. And I agree with that. I think that's a pretty good viewpoint to have. It says, wow, they did it again. Switzerland's central bank unexpectedly cut its policy rate to 1.25%. And whenever you get these rate cut cycles, you know what goes up? You got it right, gold and silver. It's the uninversion of the yield curve. That's what could be coming ahead of us. Investment, another quote here. It says, value investing is, at its core, the marriage of a contrarian streak and a calculator. So you're buying something that's down because it has value, and you've got the marriage between being a contrarian and doing some math to ensure that you've got that value that's in the stock. We've got home builder KB Home. It's ranked 545 on the Fortune 1000. So here's new orders for Q2, and it looks like it's pretty flat across the board. 2019, about 4,000 homes. 21, 4,300 homes, about 4,000 homes, 4,000 homes, 4,000 homes. So it's pretty steady in terms of how many homes it's building through all those years of 2019 through 2024. And there it is, the steadiness that we've seen in home building here. We don't have anything crazy like 2003 and 4 where we really went up here. 03, 04, 05, that's where we went crazy in home building. We're at much lower levels than that, and we've got a larger deficit in the housing market than we did back then. Coming on back, we've got so this is in January of 2011. Silver was just as stretched above the 200-day moving average as it is today. It didn't prevent it from rallying all the way to $50 in the following months. So some people were basically going back and forth, and I'll read what they were doing. They're saying Gary's been talking blah 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 about a bunch of different things and how it's overstretched. He says there is zero chance of starting another sustained rally until price closes a lot more of this gap back to the 200-day moving average. I am not in that camp. I think these things can get super stretched over time above a 200-day moving average. It says, wasn't silver stretched too far above its 200-day moving average here in 2011, and then we had a nice big run from $30 to $50. I'm not going to try to get in this fight, guys, but you can run, you can get very stretched, you can blow off top. There's a whole bunch of things that can occur. Not stating that will occur, but I'm just stating that trying to say that something can't or there's a 0% chance. I don't know if I'd go that far. Logan said, see, here's Nick. He says, why have home prices surged in 2020? Because the supply of homes for sale, aka inventory, has plummeted. However, don't expect this trend to continue into 2021. And then it says, what's interesting is that the real estate mainstream keeps saying there's a housing shortage, just as inventory and supply is skyrocketing in many states across whatever for June 19th. And of course, he's just laughing at this because home prices continue to go up in the face of that, of what he thinks is really bearish news. Here's myth versus reality. I wanted to talk about this. He says EVs wear tires down faster than gas cars. Reality, EVs consistently received more tire tread depth alerts than ICE cars, especially as the vehicles aged. So what they put for this as a chart, it doesn't make any sense. They say tire age in years, which doesn't really matter because your wear is dependent on not your tire age, but most likely miles driven and how hard you drive the car. And then they've got percent of tires with tread depth alert. I think this is an absolutely garbage thing to put up. Be careful who you're following on this stuff. That's a really poor post in my opinion. And it really doesn't give you any sort of, it doesn't give you an opinion on why EVs wear down tires faster than ICE vehicles. It just has to deal with weight. That's all it does. So coming on down, we've got, we have to do this thread again. 98,000 new homes completed and available for sale in America today. This data line never got to 200,000 during the housing bubble crash years. We had 4 million active listings in 2007. All of you can do the math in your head here. And this is new houses for sale by stage of construction completed. And you can see how low we are compared to the movement here of 2006 and 7. We overbuilt, guys, and we're still in that building process, and go way higher than where we are today, and continue forward and go eventually into a hypersupply phase. We're not there yet, though. We're not there yet. Home builder sentiment has dropped to the lowest level this year. Is this a sign? Now, the thing that I would say is each one of these low levels is a good time to buy, not to sell. So I would be contrarian and say, like, this is good because we're not at a high level for home builder confidence, which means that they're hesitant to just build a bunch of homes, which is good. We've got silver squeeze, so the hard part is done. The path of least resistance is up. Sit tight and stop trying to get cute with the timing. Totally agree with that. Sit tight, guys. We're breaking out. Residential electricity prices across the continental United States. Looks like they are high on this coast. The ones who've adopted the most amount of renewables probably has the highest taxes too, which leads to higher pricing. Every time this happened, it ended in a recession since 1966, with the only exception being 2015. And this is industrial production is contracting. So are we going to get a recession? I don't know. It seems like it's already low. And every time you get to these levels, you get a recession, correct, but that means we're already in it. Looks like NVIDIA is cashing out. Insiders have now sold more than 700 million worth of shares this year. NVIDIA insiders cashed in on rally as shares sales top 700 million for insiders. Not a good sign if you are looking for NVIDIA to continue higher. Lyd Alden says nothing stops this train, and she's talking about fiscal spending. CBO boosts 2024 U.S. budget deficit estimate to 1.9 trillion from 1.5 trillion. And that's that fiscal spending that she's talking about. India will add more new coal power capacity in almost a decade in order to cope with surging electricity demand. The nation expects to add 15.4 gigawatts in the year through March 2025. The reality of rapid economic growth has prolonged reliance on coal. There's that big move in India's coal power capacity to rise most in nearly a decade. Huge move in coal power. Most new single-family houses for sale since 2008. We are rocketing back up for new one-family homes for sale in the United States. Again, that's what this one is up here. Looking at this guy coming across. It's not as much for new houses that are at the stage of completed. So we've got some ways to go there. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got. So we'll catch you next time. This is Finding Value.